Hey guys, today we're going over why market hype like the current Facebook FOMO is bad for your health. We'll talk about one of the biggest mistakes investors can make and how to stay disciplined. We've got Daren Blonsky from Sonoma Wealth Advisors to break it down for us. And make sure to hit subscribe if you want regular insights on investing in personal finance from professional portfolio managers and investment advisors. Let's jump in with Daren. Hey Daren, good to see you. Happy Friday, man.
You too, Jeff. We did it. Another week in the books.
Another week.
It's for sure.
Exactly. So talk about that. I mean, we're kind of talking about Facebook FOMO and maybe being bad for your health and maybe bad for your portfolio, even though Facebook's looking good right now. It's really trending. A lot of people talking about it. Meta's looking positive right now. But why would it be kind of the whole idea of Facebook FOMO? Why would that be bad for your health or your portfolio? Kind of give us your take.
Well, here's the thing to remember when it comes to portfolio. There's lots of ways to be successful in investing, right? You could talk to every investment advisor out there and they're all going to have slightly different strategy, and each strategy could actually work. The successful investors stick with the strategy that they pick, right? One of the big mistakes that investors make is they try to switch up their strategy because something else is doing great. And we've seen a lot of that in the last couple of years with the Mag 7, as they call it, which Meta is one of those. And those are the Magnificent 7, which are really focused in, we call the 9 style box for Morningstar. It's up in that growth, large cap growth section, is really driven most of the outperformance. If you look at the rest of the market, it really hasn't done all that well. And so when the financial media is reporting like, hey, all-time highs, and you really look at what that all-time high means and where it's coming from these Mag 7. And Facebook's the latest one, right, to just go to the moon. And they yesterday came out and said, hey, we're going to offer a dividend so Zuck can get $700 million every time the dividend pays out. And I don't know why they did it, but anyway, it's, you're faced with this question as an investor, just like so many of us have been faced with the question as an investor with NVIDIA. Like, is this thing done? Is this move done? Should I pile into it now? And that's the dilemma of every investment manager. And so when these moments happen where some type of stock surprises to the upside, if you're not already in that trade, I would say generally it's best not to chase that trade because the move's already in. Somebody in the market already knew something and it's already happened. And I would say 9 out of 10 times, if you chase that momentum trade, you generally don't win because you just can't get in quick enough and back out quick enough when the trade is done. And that's just the reality of it. And it's hard to accept that as an investor, but it's just the way it is.
So what do you do then? I mean, again, like you're talking about last year, the performance for the broader market outside of that, the Magnificent 7, the NVIDIAs, the Facebooks, the Apples of the world was pretty poor. And so what if you're in you have your strategy and you're only doing maybe a couple percent versus you're seeing the broad market do 20%? I mean, how do you kind of stick to that? Do you say, hey, do I rethink a little bit of something, kind of my portfolio for 2024, or you just stick with your guns? How do you kind of navigate those ups and downs where you're, hey, maybe drastically underperforming one year, but you're still up a little bit? What is kind of the outlook and the position change that you would take?
Well, I think you have to first understand why your portfolio is not performing. And if you understand why your portfolio is not performing and why you have the positions you have, then you have to go back to your assumptions and interrogate your assumptions and say, were my assumptions about this position correct? Because it's actually possible to make the right decision and still be the wrong decision. Now, that sounds crazy talk, but it's true, right? In investing, because your decision to invest in a certain allocation could be the right decision. It just didn't work out the way you thought it would at this time. And I will go back to the phrase "at this time," because we saw this happen last year in the markets, right? I was getting calls from my conservative investors in late October saying, Daren, my portfolio is down. What's going on? These stocks are doing great. Why is my portfolio not up? Because they were largely in the bond market. And the bond market had an awful last couple of years. And they're like, what is the deal? I'm like, look, it usually doesn't make sense to change course now because right in that moment of capitulation, that's the moment where the whole thing flips on the head. And that's when you lose money. And we saw that in October, late October, and the market just hockey sticked on us, right? But there were lots of people scared out of their mind right at the end of October. And that was the end of it.
And that's, I
So
mean, it's typical of what we talk about, right? You know, the kind of the adage is like the topic, right? You know, fear of missing out. You know, that greed comes in where people buy at the top, they're jumping in at the wrong time, they're trying to get on that train, and then they get freaked out and they sell at the bottom because they're afraid. So the whole thing of, you know, chasing after that momentum, you know, trade, or chasing after the hot topic of the day, you're saying stick away from that. You have to basically stick to your guns, stick to your strategy, be flexible, I guess. But where does that strategy come from? Like, how do you kind of put together your thought process that you know that you're going to be able to stick to through, you know, years, or a year or two or three of maybe underperformance of the broader market for various reasons?
So I'm going to answer that question directly, but real quick, I'm going to go back to, and I call it with my clients, I call it the barbecue benchmark. And I make it, and I say that as kind of a joke, right? Because, you know, often when you're an investment advisor, you start with a benchmark, right? So you say, okay, what index am I looking to track this portfolio to? What's the expected volatility of this portfolio? And as an investment advisor, you're like, well, I'm going to do a 60-40, and I'm going to use the S&P as my stock benchmark, and the ag is my bond benchmark. And clients look at you and say, that's great, but all I really care about is what my neighbor says he did at the barbecue. And so I call it the barbecue benchmark, and that's where it starts. And so having that conversation and figuring out, like, where's this information coming from, and should I be listening to it for your investment behavior, is really the important question you need to ask yourself. So as an investment advisor, the way you start with that benchmark, you build off that benchmark and go from there. And that's what you've seen. These 60-40 portfolios have just stunk compared to the NASDAQ or a pure S&P portfolio, and people aren't happy about that. But it's just the reality that just because an asset isn't performing right now doesn't mean that it's going to. And we like to call it the alligator jaws. And those alligator jaws tend to shut. You just don't know when, right? So in a perfect world, we would have this, you know, crystal ball that would tell us invest in NASDAQ and then get out at this point, and then go over here and invest in bonds, because then bonds are going to shoot up because interest rates are going to go down. But we saw that with Chair Powell yesterday, where he goes, oh, March, or was it Wednesday? He said, you know, March rate hike, it's off the table. Not doing it. It's like, rates start shooting up again, right?
Yeah.
Because they're still fearful that inflation is going to reoccur. And we saw that in the jobs data this morning that came out, when we just blew the jobs data out of the water. Now it'll probably get revised a month from now, but it doesn't really matter. The market's still going to react now. And it's telling us the economy is way stronger than maybe we think it is. It's telling us that inflation is probably still in the system. And that if Chair Powell starts lowering and doing what we call maintenance lowering of the rate, then you're going to have issues potentially with a reoccurrence of inflation. A lot of these central bankers, they were central banking and starting their careers in central banking back when we had our last bout with inflation, where we had the camelback, where it actually went down and then went back up. And so they're fearful of that moment.
So a couple things. You kind of talked about, you know, the 60-40 portfolio not performing, you know, and people are getting pissed off, and they're looking at this outperformance from the Magnificent Seven and the big tech names. But you're like, hey, listen, the alligator jaws are going to drop at some point. So you can't just go chasing that momentum trade. It kind of reminds me of, if you remember Moneyball with Brad Pitt, and he's you know, the inception of kind of analytics in baseball. And he's sitting there with the owner, and they're like 10 games out of first in the division. And he's like, you know, the numbers still play out. You know, after the All-Star break, we're going to be in a better position. And it turns out that he changed baseball, and they went on the biggest winning streak in history. Kind of the same thing kind of apply here, right? That you can just stick to your guns if you're confident in the decisions that you went in with that strategy with, whether it's a 60-40. And there's a reason that you went with the, you know, if it's a straight 60-40 portfolio, right? But the flip side of that is, like you're talking about with the Fed decisions, and that you could have a portion of your portfolio that you could go and chase some of these momentum swings. Is that kind of an option from your perspective? You got your kind of core portfolio in the 60-40, and you stick to your guns. But if you want to play around a little bit, then you can kind of look at some different strategies.
we actually encourage it with clients. I call it the dopamine dump. And the dopamine dump is basically like, you need a little portfolio that you can go put in and you can roll the dice and see what happens, right? Because here's the deal. I don't care who you are. I don't care how smart you are. If you pick 5 stocks, one's going to crush it, one's going to suck, and 3 are going to do nothing. And that's just the way it generally works out, right? Mm-hmm. But here's the thing. Which stock does your neighbor tell you about at the barbecue? Yeah. The one that crushed it. That's it. He didn't talk about before that didn't do nothing and actually blew your portfolio up, because that one stock has to lift heavier than those other 4. And so what we train our investors to do is have a dopamine dump. And we joke about it, right? It's like we all need the dopamine, right? We're humans first and foremost. So we have to understand our human inclinations. And then once we understand our human inclinations, we can set up systems to work for our human inclinations, not against our human inclinations. And the human brain is not designed to be a good investor. It is just not. There's so many psychological biases and behavioral biases that get in the way of good investing, that if you don't set up things like a dopamine dump. So put $5,000 inside an account and go chase that Facebook trade. And maybe you'll win. Maybe you won't, but don't risk your retirement on that. That's crazy, right?
Exactly. And it's kind of like you talk about the barbecue benchmark. Your buddy, and it goes back to the FOMO. You don't listen to your neighbor sitting in front of the barbecue, because he's only going to tell you about the one that won. It's the same thing with venture capitalists. Their whole business model is to invest in 100 companies, and one of them is going to actually hit it and become a VC or become a unicorn. It's going to pay for the rest, and some of them are going to kind of do mediocre in the middle there. And the same thing is lies here, that you can be the barbecue guy and you can tell them about your little $5,000 or $2,000 portfolio that absolutely killed it last year with the Magnificent Seven, but you're not for this, chasing that dopamine, chasing that FOMO, just because your neighbor talked about one pick that he had when he got into, Bitcoin in 2012, whatever it might be.
It's like survivorship bias, right? Even in the private equity space, right? Like, nobody's talking about all the guys that said to their wives, I'm going to go into private equity, or, and then they're working for McDonald's now. They just don't talk about it. The same thing is nobody's talking about that one stock that blew them up. Now, people talk to me all the time about it because they want me to remove it from their portfolio after it's zeroed out. Mm-hmm. But that's just the reality of it, right? And I always ask myself this question, Jeff. I always say, what do I know and what expertise do I have that's going to make me better than the average? And if I'm really honest with myself, I'm average. I know my mom told me I wasn't average, but I'm average. And unless I got a mechanism or a system in place, I'm average, man. We're all average. And if you don't accept that humility to the markets, guess what? They're going to deliver a humility pie to your face. And that's the reality of it. And you just have to accept it.
Yeah. And that's the point. I mean, it all kind of ties back to the fact that you have to have a system, a strategy in place that you can rely on, because you can't rely on yourself and your fear of missing out or your fear of losing out, whatever it might be. So I always appreciate the insight. Investors, if you didn't know, you can check out Daren's portfolio, the Gazelle Portfolio. It's available on EchoTrade. Basically, you can copy exactly what he's doing in his own account. So again, you don't have to figure it out for yourself. Daren's got the strategy. He's got the formula that he puts in place, and he's got the wherewithal to stick to it through different market cycles. But always appreciate the time. Always enjoy the conversation, Daren. And till next time, have a good weekend, man.
All right. Thanks, Jeff. Take care.